Standard costing, otherwise variance analysis. Otherwise variance analysis. Let's start with the first illustration, and I'll explain what is standard costing, and then I'll go for solving these illustrations one after one. Now, okay. Standard costing or variance analysis. Whatever the cost we estimated for production of any commodity, after completion of the production, we will compare with the actual cost. Usually, the standard cost will not match with the actual cost. Now, you have to find out the reason for the mismatch. Reason for the mismatch. Okay. Maybe due to excess consumption of the material or change in the price. Change in the price. Quantity related or price related. Okay. And these two are the predominant. Sometimes we have the mix related. We'll see that later on. The cost could be not only related to the material, maybe related to the labor, maybe related to overheads. In case of overheads, other than labor and material, we can segregate that into fixed as well as variable. So we may now break down the variances related to the material, labor, fixed overhead, variable overhead. And then the reason is due to the excess consumption of material or lesser consumption of material, or the price we pay for the per kg material may be higher or lower. Because of that, if there is any change, it will also be identified. In case of labor, rather than completing the material in 10 hours, we may complete in 15 hours. So excess consumption of hours, and the hourly rate may be higher. So then the estimated our standard cost. Right. Even in case of material and labor, we don't have one type of material. We may have 2 or 3 different types of materials. For manufacturing the table, we can manufacture using the steel or plastics or wood or glass. Sometimes a combination of all these things. So we assume that combination of 2 materials are used, wood and steel used. Right, wood and steel. So the tabletop may be wood and other things, other parts may be steel. Sometimes later, they may change the proportion of wood component as well as steel component to get good look or stability or price. Because of the proportion change of these will be called as mix variances. So these are the 3 predominant variances we will be studying here. For each and every aspects. For material, we have labor, we have these variances, fixed overheads as well as variable overheads. Apart from that, sometimes we may fix the price totally different. We thought we can sell the product for 10 rupees, but in the market we can sell it only for 9, or we may sell for 11. Because of the fixing the sale price higher and the lower than the standard cost we fixed, we may get our profit gets affected. We estimated that 1 lakh units could be saleable, but actually we sold 1 lakh 20, or we sold only 90. Because of that reason also, we may have some impact in the profit and loss. So we need to study why we estimated cost, the cost we estimated is not matching with the actual cost. So the cost may not be a single term. It may be collection of various costs like material, labor, overheads. In that overhead, we have the fixed and variable. And the cost may be due to the excess consumption of the resources, or the price per unit of the resources may be varying because of that. Sometimes we may have 2 or 3 resources for manufacturing, and the composition proportion may be also be changing. Because of the changing the proportion, also the means cost may be totally different. So these are the 6 variances. Apart from that, sales price as well as volume. So these are the 6 variances you are going to study. Material variances, labor variances, variable overhead variances, fixed overhead variances, and sales variances, and sales margin, profit based variances. We are going to study all these aspects. Sometimes we may have 1 and 2 combined, called material and labor variances in same problem. Actually in an organization, they will have all the components, right? So we have to calculate what is the variances due to the material, labor, overhead, and price and all. If you are studying all these aspects and preparing that statement, that is called comprehensive variances, right? Anyhow, for CMA Group 1, you have to cover these 3. These 3 are for CMA Group 1. Okay. Up to 7 is for CA Group 2. And all will come under CMA Group 2 and CMA Group 3. Clear? So in CMA Group 2, it's management accounting. In CMA Group 3, it is strategic cost management, SCM. Okay. So anyhow, we cover the 3 topics commonly for all. Of course, 4 to 7 CMA Group 1 students can just listen, not required to do lots of practice. And 4 to 7 is required for the CA Group 1 as well as CMA Group 2. The last one is not required for the CA students at all. So we'll see all those things at the CMA level. Clear? Let me start with the first aspect here. Hope now you'll be able to understand the differences between the cost we estimated and cost actually spent, which is going to be studied under standard costing or variances analysis. Why the estimated cost is not matching with the actual cost as per this provision, material variances, will be studied here. See, we have been given 2 aspects. One is standard, another one is actual. In actual, we'll start with the first option. This is the first option. Okay, we'll start with the first option. Standard being 1 unit of output produced with 20 kgs of material, and rupees per unit being 100. Total cost we spend as per my standard estimation being 2000. Okay, the output being 1 unit. But actually in option number 1, we are studying the option number 1. In option number 1, the actual consumption for producing the material being, or finished goods being 21 units, and per unit cost us me 105. Overall amount I spent here being 2205 rupees. 2205 rupees. And the actual output also be 1. The output as per the standard and actual being equal, then you can start compare the value differences. You have to verify this one always. Always you have to verify whether the standard output and actual outputs are same. If it is same, then you can calculate the reasons for the variances. First, what is the variances here? We estimated 2000 rupees for producing the 1 unit of output, but actually we spent 2205. So we spent 205 rupees excess. So you have to name this being either adverse or favorable. If the situation is favorable for you, then it's favorable, or adverse. So you spend more money for manufacturing the same. It's not favorable situation, or I name this being adverse. So comparing the cost difference between the actual and standard will be the variances. Don't say 205 adverse alone. You have to break down the reason for this 205 changes also. For that, 2 reasons are involving. Reason number 1 is all about quantity. Okay. So we consumed 1 quantity excess. So as we consume one quantity excess, definitely it's adverse only, right? As well as amount we paid per quantity being 5 rupees excess than the standard. We estimated only 100 rupees per kg per unit while planning for production, but while going for the real production, the actual cost being 105. So we spend around 5 rupees excess. 5 rupees excess. Clear? Now tell me. Now tell me. So as per your standard, okay, as per your standard, how much you are spending here? You consumed 1 rupee excess, 1 unit excess as per your actual cost. Come on, tell me what's the value you are getting. Okay, 1 rupee you are consuming more at the standard cost. How much will be the value you are losing? 100 rupees you pay extra is the adverse. Is the adverse. Now tell me, you are paying how much extra per unit? 5 rupees extra. 5 rupees extra paid for how many units? 21 units. Okay, for 21 units, you paid 5 rupees excess. As per your standard, you consumed 1 unit excess means for the excess 1 unit, what is the standard price? As per the standard. So, my intention is to find out the variance due to only the consumption. Here, I consumed 1 extra as per my standard price being 100. So, 100 into 1 will be taken. For the price, I paid 5 rupees excess. Also adverts that 5 rupees paid for how many units? Not the standard units of 20. Actually, I purchased 21 units. That 105 is paid for 21 units. So 21 into 5, 105 will be taken. 105, you paid excess, then it's adverse. If you add up these two, then you will be getting what? This 205 will be the collective variances. Collective variances, total variances. Is that okay? Let me now explain here in detail. Material cost variance, this one, MCV, is equal to standard cost minus actual cost. Standard cost minus actual cost. Standard cost being this one, 2000, and actual cost being 2205. You paid 205 excess. That excess payment is named as your adverse. Your adverse. Similarly, you have to break down into the price as well as quantity. Material price variance is equal to, how do we calculate? This 5 is what? The difference between standard rupees or price minus actual price. So, standard price minus actual price. I thought I can spend only 100 rupees, but while really purchasing the material, I spent 105 rupees. So, I paid 5 rupees excess. 5 rupees excess. That 5 rupees excess for how many units? Actual quantity purchased being 21. To that extent, I paid this one. So, into actual quantity will be taken here. Now, standard price being 100 and actual price being 105. I paid 5 rupees excess for actual quantity being 21 units. So, 105 adverse. 105 adverse. And in case of material quantity variance, you have to start with standard quantity, because what is a change in consumption of quantity will be the matter in case of quantity variance. So, standard quantity minus actual quantity will be taken, multiplied with standard price, because my intention is to find out the variance due to the quantity only. So, price will not be considered here. Standard price will be considered here. Okay, standard price. Now, standard quantity being 100 as per my estimation at the time of giving the quotation being 20, but actually I consumed 21 units for producing the same commodity. Okay, as per the standard price, I spent 100 rupees excess for the excess commodity consumed being 100 rupees adverse. Check. Material cost variance is nothing but the broken down value of material price variance plus material quantity variance. You can cross verify this one also. Material cost variance in this case being 205 adverse, and material price variance being 105 adverse. 105 adverse. Material quantity variance being 100 adverse. 100 adverse. Is that clear? Hope now you'll be able to understand this part. You'll be able to understand this part. Clear? Any doubts here? Now, material cost variance is otherwise what? Standard quantity into standard price minus actual quantity into actual price. Come on, try to copy, then you move on to the next illustration. You can try all the 5 options here. I have solved the option 1 and 2, 3, 4, 5. You can solve it yourself. So start with standard and go for the option number 2 for actual. This is the standard, this is the actual. Come on, try for this. And then you can try for 3, 4, 5 also. Make it faster. Come on. Those who are not completed can complete. The others who have completed this, you can start try the next illustration yourself. Make it faster. Clear? Come on, text me once it is over. Make it faster. Make it faster. Yes, we'll now move on to the second option, standard and compared with the option number 2. What about the material cost variance? Standard quantity into standard price minus actual quantity into actual price. This is standard cost, this is actual cost. Material price variance is nothing but the variance between the standard price and actual price. So standard price minus actual price. This price will have the impact to the extent of actual quantity will be taken, and material quantity variance related to the consumption of material, raw material. So standard quantity minus actual quantity multiplied with standard prices taken. Now standard cost being 2000, actual cost being 21 into 95. Come on, get me the value. Only 5. Okay, I'm getting 3 or 4 5s in my ears and surprised 55 or 555. It's only 5. Favorable or adverse? Favorable. Good. Standard price being 100, but actual price in this case being 95. 100 minus 95 into actual quantity in this case being 21. So you consumed 5, you paid 5 rupees lesser, so it's favorable. 5 into 21, 105 favorable. And in case of quantity, 20 is the standard, but we consumed 21 extra 1 extra consumed. Standard price in this case being 100 rupees. So as you consume 1 unit extra for 100 rupees, at the rate of rupees 100, it comes around 100 adverse. Okay, check. Material cost variance is equal to material price variance plus material quantity variance. This is 5 favorable, material price variance 105 favorable, and we have 100 rupees adverse, ultimately 5 rupees favorable. Okay. Clear? So try the next one. Third option. Third option. Now, I'll go for the third option compared with the standard. Material cost variance, standard cost minus actual cost, material price variance, standard price minus actual price. This price will have impact to the extent of actual quantity purchased. Material quantity variance, standard quantity minus actual quantity, multiplied with the standard price. Now check. Material cost variance is equal to material price variance plus material quantity variance. Always remember, actual quantity should be equal to standard quantity, only then you can compare. Yes, this is correct. Actual quantity output being one actual output. Okay, actual rather than actual quantity, it may be actual quantity of output. Okay, to differentiate. If these two are same, then you can directly apply this formula. Now, standard cost in this case being 2000, actual cost 19 rupees, 19 units at rupees 110. Yeah, find out the ultimate value. 90 adverts, 90 adverts. In case of price variance, 100 and 110. 100 is the standard price, 110 is the actual price. Actual quantity in this case being 19. You pay 10 rupees excess for 19 units, means 190 you paid excess. If you are paying excess, then it's not favorable for you, adverse. Similarly, in case of quantity variance, standard 20, but we consumed only 19. In this scenario, it is favorable for us. So 20 minus 19, it's favorable by 1. And then standard price in this case being 100. So 1 into 100, 100 favorable here. So you can cross check material cost variance 90 adverse, which is equal to material price variance 190 adverse as well as favorable quantity variance. If I add up these two, then I will get the material cost variance without any problem. Clear? Hope now you will be able to understand. Shall I move on to the next one? Third option is over. Online students keep responding. I'm getting the response from only very few of the very few of you. Make it faster. Let's move on to the fourth one. Standard as well as the fourth option. So material cost variance is equal to standard cost minus actual cost. Actual cost is nothing but standard quantity multiplied with the actual quantity multiplied with the actual price. Material price variance is related to the variance due to the price, standard price minus actual price. This difference in price will have the impact to the extent of actual quantity purchased, AQ. And material quantity variance, standard quantity estimated, actual quantity you actually consumed, the difference between these two. This variance difference I need to know at standard term, so I take the standard price. Apart from that, to cross check, material cost variance should be equivalent to material price variance plus material quantity variance. Material quantity variance. Is that clear? Now, what is the check you have to do? Actual output should be equivalent to standard output. Standard output 1, actual output 1. So, this one is true. Then you can straight away calculate the entire illustration. So, standard cost in this case being 2000. Actual cost in this case being 19 into 95. 1805. So, 195 favorable. Am I right? 195 favorable. Find out the reason for the differences. In case of price, rather than paying 100, we paid only 95. There's a favorable situation in this case. This will have impact to the extent of actual quantity. 19. Yeah, come on, tell me. 95 favorable. Similarly, in case of quantity variance, standard quantity being 20, actual quantity 19. Here also we consumed lesser, so favorable situation. And as per the standard price being 100, I paid 100 rupees lesser, then it's favorable. Okay, cross check. Material cost variance being 195 favorable is equal to material price variance 95 favorable and material quantity variance 100 favorable, matching. So now the importance of standard costing is to find out the variances between your standard as well as actual, and then break that into smaller component and different component, like due to the price or due to the quantity. If it is the reason due to the price variance, then you can consult with or contact the seller, demand him to reduce the price and ask him why you charge more. So compared to the estimation we have done earlier. And the explanation may be satisfactory. He may say that, sir, yes, last year the value is 10, sir. This year entire price is changed. It's 10.5. So we charge only 10.4 with a discount only. Just go on inquire any other seller. But if he says that, no, sir, we revised, then we now try to find out any other seller available to sell at lower price. So we can change the seller also. That's how we can make the decision. How can we reduce our cost cutting can be made with respect to the supplier. Similarly, in case of quantity variance, we have to verify whether why we consumed more quantity or lesser quantity. If we consume more quantity, verify whether there is any theft or inefficient or inexperienced employees are mishandling the material, due to that lots of wastages, or the supplier might have supplied the material with a substandard quality, because of that we may face lots of damages. Then you can again analyze the reasons for the quantity variances. Give a summary to the management so that they can reduce the costs they spend for manufacturing commodity. Is that okay? As they can reduce the cost they spend for manufacturing, naturally they can either increase the profit or they can offer lesser sale price to the customer to boost the sales and reputations from the customers also, right? That's what about the ultimate aim of variances. Here, the very first instant, our focus is only to understand material variances. Thereafter, we go for the labor, variable overhead, as well as fixed overhead variances and all. We'll now move on to the fifth option. Fifth option, okay, with the standard. So, material cost variance is equal to standard cost minus actual cost. Material price variance is equal to standard price minus actual price into actual quantity. Material quantity variance is equal to standard quantity minus actual quantity into standard price. Cross check. Material cost variance is equal to material price variance plus material quantity variance. This variances chapter is very, very important for scoring definite sure mark. Even in case of marginal costing, lots of assumption and lots of practice needed. But in case of material, means standard costing, even a bit of extra efforts is enough to guarantee mark in this topic. Anywhere between 8 to 12 marks, very often you can expect the questions from this chapter. Okay, even at final level also. That too in short duration. Okay, 12 marks, you can take around 18 minutes in your examination. But for 12-mark question, if you are strong with the material costing, you can finish off in a matter of 10 to 12 minutes. It's a time saver. But marginal costing, it's not so. There you need to have lots of working in your examinations. But here it's one of the simplest chapters. Very often you can score good mark also. Okay, put more importance on this chapter. Now, verify whether the standard is equal to actual. So, standard output in this case is equal to actual output. Try to verify. No, sir. Then the given information cannot be taken as it is. You have to do slight change. How? Here, for 1 unit, the standard is given. Now you have to make standard for 2 units. What could be the standard for 2 units, right? So always remember, if the output for the standard is different from the actual output, then find out the standard cost for the actual output. For one output, you need to consume 20 units, means for 2 output, how many units you have to consume? 40 units. Of course, the material price per unit remains 100. Is that okay? This is what about the standard for the output of 2 units. Now you can compare these two. Now we can compare these two. Is that clear? Hope now you'll be able to understand this logic here. Now let me start here. Standard cost in this case being 40 and 100. 40 units needed, 100 rupees. Actual cost being 35 into 102. Come on, tell me, what's the value you are getting? Huh? 430. 30. Okay. 430 favorable. Favorable. Okay. And standard price being 100, actual price being 102. 100 minus 102. Actual quantity in this case being 35. 35. 2 rupees into 35, 70 rupees adverse. In case of material quantity variance, 35 and 40 are going to be compared. So standard quantity being 40, actual quantity being 35. You consumed almost 5 units lesser, so favorable. Multiplied with the standard price being 100, so 500 being favorable. Now you can cross check by using the formula for checking. Material cost variance being 430 favorable, material price variance being 70 adverse, and material quantity variance being 500 favorable. 500 favorable. Is that clear? Clear? Come on, text me. We'll move on to the question number 2. In this illustration, I'm going to introduce stocks. Remember, the standard price is usually will be equivalent to usually equivalent to actual price of the previous year. Okay, for example, in the previous year 24-25, for every quantity we paid 100. If we want to make a projection in the year 25-26, okay, now the actual price in 24-25 previous year being 100. If you suppose to estimate the cost for 25-26, what do? You are aware about the current price. You think the same price may continue in this year also, so you will consider this being standard price in the subsequent year. This is nothing but standard price we estimated in the coming year based on the previous year. But the actual price may be totally different in the year of 25-26. We made this decision on 1st April 25. During the year, the price may be gradually changing to 102, 105, like in the over the year. So, remember here, the standard price of the current year is nothing but the actual price of the previous year. In this illustration, this understanding is very, very important. Material variances, because standard for per unit of output being 100 units of raw material at rupees 10 per unit. That's what about the standard. This standard is nothing but what? Actual price for the previous year. Actual output being 100 units. So we have been given the standard for 1 unit, but actual for 100 units. So absolutely you cannot compare directly, right? You cannot compare directly. So you have to find out the standard for how many units? 100 units, only then you can compare. Is that clear? Now, purchases, opening stock, closing stock details are given. Actually, what you have to take? Only to the extent of material consumed for producing this 100 units is the matter. So, opening stock plus purchases minus closing stock will be the consumption. 10,000 purchases, opening stock 3, so 13. Closing stock 2,000 means we might have consumed 11,000 units. 11,000 units might have been consumed. Clear? Hope now you'll be able to understand. Now, standard, quantity, rupees per unit, and output being 1. For 1 unit, we are in need of 100 units for producing 1 unit of output. Price per unit being 10. Actual in this case being 100 units is the output, and number of units purchased 10,000. All the purchases will not be the actual cost of consumption. Though you purchased 10,000, remains 2,000 being outstanding, means you could have used only 8,000 units. To the extent of units used will be your cost. So here, purchases plus opening stock minus closing stock. Opening stock plus purchases minus closing stock. 11,000 units consumed. Now the price is question mark. Right? While comparing the actual and standard, you have to always cross verify whether the standard output and actual outputs are same. No, so you cannot compare. Then we have to calculate the standard for the actual output. The actual output in this case being 100, for 1 unit the input being 100 means for 100 the input should be 10,000. The input should be 10,000. Is that clear? Clear? Any doubts here? Okay, standard output at the rate of rupees 10. Sir, why don't we know this value, sir? Because opening stock is nothing but previous year purchased item. The actual price for this being standard price. Standard price. As I already told you, know, opening stock is nothing but previous year information. The actual cost is equal to actual cost of the previous year is equal to standard price estimated for the current period. Now, calculate the variances for all the options under first in first out model. So I'm going to assume the first in first out model. Actual quantity consumed in this case being opening stock of raw material plus purchase of additional raw material minus closing stock. Then you will get raw material consumption. This raw material consumption is the actual quantity. I need to get that. Opening stock in this case being 3,000. Purchases being 10,000 units at rupees. Okay. At rupees in total cost being 1,10,000 at rupees 11,000. You can get this value as a missing data. 1,10,000 for 10,000 units means per unit being 11 rupees. What about the opening stock, sir? Opening stock is nothing but what? Previous year actual cost. The previous year actual cost of this opening stock is nothing but standard price, which is 10 rupees. 3,000. 3,000. Is that clear? 30,000, sorry. 30,000. So we got this value. So overall, 13,000 units. Still we have 2,000 units unused. For the production of the given output 100, we have used 11,000 kgs of raw material. 11,000 kgs of raw material. Now, tell me, what is the price of this one, sir? So, under FIFO model, what is the price? I have to calculate this. Okay. So, under FIFO model, how do I get? The consumption 11,000 units. First stock we have in our godown, we may be using that first of all. What is the stock we already have? 3,000. Existing stock is used. Thereafter, once it is used completely, we can go for the new fresh item to be used. That is what about the FIFO method. First in, first out method. First in item is going to be used for the production. Means first out here. Balance 8,000 will be the new one. This 3,000 units valued at rupees 3. This 8,000 units are valued at rupees 11. We have two prices, two standard prices. Now come on, we can calculate material cost variance. Standard quantity into standard price minus actual quantity into actual price. Material cost variance and then material quantity variance. Material quantity variance, standard quantity minus actual quantity into standard price. Material price variance. Material price variance. Standard price minus actual price into actual quantity. What is the standard quantity here? 10,000 units. Standard price here being 10. Actual quantity being 11,000 anyhow. The actual price may be totally different here. 3,000 into 3, 3,000 into 10, opening stock valued at previous year's cost, right? Which is standard cost, 30,000. This being 1,10,000. Okay, 88,000. Sorry. Okay. Then overall value being 1,18,000. So this value being 1,18,000 rupees. What is the ultimate value you are getting? You paid 18,000 excess, so adverse. In case of quantity variance, standard quantity being 10,000, actual quantity 11,000 units consumed, standard price being 10,000 adverse. Standard price minus actual quantity, actual price into actual quantity can be written this way: standard price into actual quantity minus actual price into actual quantity. So standard price in this case being 10 rupees, standard quantity 10,000. Actual price into actual quantity is 1,18,000 rupees. Already we calculated. This is nothing but actual quantity into actual price. Okay. This is 10 into 11,000. Okay. 10 into 11,000. Now the value being 8,000 adverse. If I add up these two, you'll get this value. If I add up these two, you'll get this value. Is that clear? So this last price variance is slightly different here because we have two prices. Okay, you can multiply AQ within so that you will get the answer easily. Clear? Otherwise, the shortcut is there. The shortcut in this case is nothing but standard price minus actual price into actual quantity meant for variances. Actual quantity meant for the variances. Standard price also 10, actual price also 10. So, to the extent of 3,000 units, there is no reason for the variances. The reason for the variances is only to the extent of 8,000 units. Am I right? Standard price being 10, actual price 11, this excess payment of 1 rupee applicable only for 8,000 units. That way also you will get the same answer. Either you can calculate the format I have given earlier, or you can assume only to the extent of variance what could be the number of quantities will be taken here. Not the 11,000 units only, 8,000 units will play the role. Only 8,000 units play the role. Clear? Make a note of it. Make it faster. Text me. Now, in case of next model, lost in first out model. Lost in first out model. In this case, the consumption 11,000 units in actual. First of all, we consume from the newest purchased item. Lost in means lost item will be used first. We have two items here. One is old item, another one is newly purchased item. Otherwise, this is the latest item. The latest item will be used first. After we complete that, we will go for the earlier or oldest one. So 1000. The latest one costing rupees 11 and the oldest one costing rupees 10. This will be at the rate of rupees 10. Now we can calculate the rest as usual. Yeah, come on, make it faster. Material cost variance is equal to standard quantity into standard price minus actual quantity into actual price. Standard quantity in this case being 10,000 units, standard price being 10, actual quantity into actual price is nothing but the summation, this value, okay, 1,10,000, this is 10,000, 1,20,000 is the value. So here you have paid around 20,000 more adverse. Similarly, material quantity variance, standard quantity minus actual quantity multiplied with standard price, standard quantity 10,000, actual quantity taken for producing 100 units being 11,000 units, and then the standard price being 10. So 10,000 adverse. Then material quantity variance, price variance, sorry, material price variance. Under material price variance, standard price minus actual price and into actual quantity responsible for the variances. Responsible for the variances. Standard price 10, actual price being 11. This difference is only due to newly purchased item, which is equal to 10,000 units only. 10,000 into 1, 10,000 adverse. Cross verification, where if you add up these two, you will get the material cost variance. The other way, you can multiply inside standard price into actual quantity total, not variance, total minus actual price into actual quantity. This way also you can work out, you will get the same answer. Clear? Make it faster. Now, we'll move on to the next one. I'm going to solve under weighted average price method. Weighted average price method. Weighted average price is nothing but total commodity you purchased, total price you paid for that 1,40,000. If you divide this and the value what you get is nothing but weighted average price. All these things you will study under FIFO LIFO inventory management chapter at your costing paper. Okay, at your CMA Group 1 and CA Group 1, where it's one of the easiest chapters. Now these things are incorporated already at foundation level also sometimes. Okay, weighted average price is nothing but overall amount you paid divided by overall quantity you purchased. What is the average price you paid? 1,40,000 you paid for 13,000 units, then weighted average price being, come on, tell me, 10.7777 again, or 78. I may make it 778, like, clear, 4 digits. So if you are rounding off, then definitely we'll cross check. Material cost variance is equal to material price variance, and quantity variance sometimes may not be matching. Don't get panicked with that. Slight rounding of error will be definitely exist there. Now let's see. Material cost variance is equal. Now the sum is very simple because you get the actual price being only one rate. So normal one. Material cost variance is equal to standard quantity into standard price minus actual quantity into actual price. Material price variance is equal to standard price minus actual price into actual quantity. Material quantity variance is equal to standard quantity minus actual quantity into standard price. Standard quantity 10,000 units, standard price being 10 rupees or 1 lakh. Actual quantity 11,000 into actual weighted average price 10.7778. I take 4 digits to get full value. Usually in my examination while studying this, I use this value 14 bar 13, so that you will get a rounded number here. Okay, 1,40,000 divided by 13,000 is nothing but 14 bar 13. That way also you can take, so that there will not be any trouble. 140, so 140 divided by 13. If you take this value, then you will get exact value. Like, while cross verification will get satisfied. Okay, come on, tell me what's the value. Yeah, make it faster. Okay, so final answer being 18,462. 18,461.5 adverse. In most precise. Standard price being 10, actual price being 140 by 13, actual quantity being 11,000. Okay. Ultimate value being 8,461.5. 8,461.5 adverse. Standard quantity 10,000, actual quantity being 11,000 rupee, 11,000 units, and standard price being 10, so 10,000 adverse. Okay, you will now get the answer without any deviations. Perfect value you will get. Now, under simple average price method, the price will be taken only average of these two prices. 10 rupees and 11 rupees, you can take 10.5. That's all. Rest will be used same manner. You can try it yourself. You can try it yourself. So this one being 10.5. That's all. This is what about the simple average price method. You can try it yourself. Come on, make it faster. The average of prices will be the simple average pricing method. So material cost variance is equal to standard quantity into standard price minus actual quantity into actual price. Material price variance is equal to standard price minus actual price into actual quantity. Material quantity variance is equal to standard quantity minus actual quantity into standard price. If you add up these two, then you will get this value. You will get this value. Standard quantity 10,000 into standard price being 10 rupees, actual quantity being 11,000 and actual price being 10.5. Yes, come on, tell me the value. 15,500 adverse. Standard price 10 and actual price 10.5, actual quantity being 11,000. 5,500 adverse and material quantity variance. Standard quantity 10,000, actual quantity 11,000. Standard price being 10, so 10,000 adverse. If you add up these two, of course, you'll be getting this value. Correct. Now, shall I move on to the next one? Now, we'll be dealing with question number 3, where I'm going to introduce the mix variances. Whenever we have two or more materials for producing one of the outputs, automatically price variance and mix variance will come here. Right. In this case, this one is standard per unit, the actual output being for 100 units. So these two not comparable. So we need to know what is the standard for 100 units first of all. For 100 units, we are in need of 600 units of A and 400 units of B. Is that okay? Very simple. Now come on. You can calculate the three basic variances easily. There is no any problem. What are the three basic variances we calculate here? Material cost variance, material cost variance, formula being standard quantity into standard price minus actual quantity into actual price. Material price variance, standard price minus actual price into actual quantity. Material quantity variance, standard quantity minus actual quantity into standard price. As we have two items, you have to calculate for the two items independently. For product A as well as for product B, you have to calculate separately for A as well as separately for B. I just made a change here. As a standard information is for a unit, actual output is for 100 units. You cannot directly compare. So I converted that standard units for standard input for actual output. For one output, 6 units of A and 4 units of B should be introduced. For 100 times of the same commodity will be input given as input. So 600 and 400. For A, standard price being 10, actual price being 11 for A. Okay, 11. Actual quantity in this case being 750 units. So you pay rupees 1 excess for 750 rupees excess, then it is adverse. It is adverse. Similarly for B, 12 and 13, you paid 1 rupee excess for actual quantity of 350 units. Otherwise, 350 excess is adverse. 1100 being the overall adverse here. You have to finalize this. In case of material quantity variance, again you have to calculate for A and B separately. Standard quantity in this case being 600 and 400, A and B. Actual quantity between A and B being 750 and 350. Standard price in this case being 10 and 12. 150 units you consumed more for A, per unit cost us 10 rupees, then 1500 adverse. Similarly for B, 400 minus 350, 50 you consume lesser into 12, 600 favorable. For A it's adverse, for B it is favorable. 900 ultimately adverse. 900 ultimately adverse. What about the material cost variance, sir? You can calculate for A and B separately. So for A, 600 into 10. Okay. Actual quantity being 750 into 11. For B, 400 into 12. And actual quantity being 350 into 13. How much? 4,550. Okay, 350 into 13. Come on, get me the first value. 2,250 adverse. Here, 250 favorable. Ultimate value being 2000. This is favorable. Okay, 2000 favorable. Adverse. If I add up these two, I'll get this value. 1100 and 900, 2000 adverts will be the value. Clear? Clear? Every item also be considered 750 plus 1500 adverts, 2050 adverts, 350 adverts, 600 favorable ends with 250 favorable. That way also you can do the cross verifications. Now I'm going to introduce one more variances here, which is nothing but the mix variance. Mix variance. What does it mean? Let's see. You have to compare only when the outputs are same. So by making this standard for 100, I get this detail here. Now what is the total input I have given? 1000. What is the actual input I have given? 1100. 1100. 1100. Okay. So definitely quantity consumed higher than the actual standard, right? Come on, tell me, what about the mixture of A and B, proportion of A and B introduced as input? As per the standard, it is 600 and 400, otherwise 6 is to 4, otherwise 3 is to 2 is the ratio. Now the question is that 1100 also be in the same 3 is to 2 ratio? Definitely not so. Okay. If it is being that ratio, 1100 being in 3 is to 2 ratio, come on, tell me. What could be A and what could be the value quantity of B? 660, 440 should be. This is the logic. So if you want to maintain the same proportion as per our standard, in the input we have given 1100 should also be in the same proportion, means 660, 440. But what happens here? A is increased and B is decreased. They are changing the proportion. They are changing the proportion. Why we change the proportion? So we manufacture a furniture, especially a table, with wood and steel. Suddenly wood becomes very costly. What we can do? We reduce the wood component and increase the steel component, so that we will be happy now. We reduce the output price. If you are reducing the wood and increasing the steel, the quantity we need to use for producing the raw material, means finished goods, may be higher. Probably earlier we are in need of say 20 kgs of these two put together, where 60% wood, 40% steel. Suddenly they changed, wood and steel proportion is changed, 50-50. So 50-50, then automatically what happens? The weight may be totally different. Output also gets affected. If you are changing the proportion, what is the impact is going to be calculated, which is called mix variance. Okay, mix variance, material mix variance. Material mix variance will be compared between these two. That's all. This will be named as revised standard mix or revised standard quantity, RSQ. I am introducing a new term here called RSQ. So in this case, I am going to compare the actual quantity with the revised standard quantity. Okay, clear? Actual quantity and RSQ. Come on, tell me, what's the value you are getting? RSQ minus AQ. RSQ minus AQ into standard price. Ditto like material quantity variance, but here instead of SQ, I am taking the RSQ, where RSQ is nothing but as per the standard mix, what could be the proportion of A and B mixed to the input, actual input we have made. Actual input we have made is 1100. In that standard mix, 6 is to 4 or 3 is to 2 ratio means 660 should be A and 440 should be B. Now calculate for A and B. A, RSQ 660, for B 440. AQ in this case being 750 and 350. So this formula is not a complicated one, just similar to the quantity variance, but rather than quantity variance, there we have taken SQ, but here RSQ. RSQ is nothing but, okay, standard mix for actual input. The actual input, no, but mixer should be in what proportion? Standard proportion. Standard price being 10 and 12. For A, 990 units excess into 10, 900 adverse. For B, 90 consumed lesser into 12, 1080 favorable. Ultimate value being 180 favorable. Remember, in MMB, metal mix variance, all the variances will not be adverse or all the variances will not be favorable. Okay, if we have two commodity, one may be favorable, another may be adverse. Two may be adverse, one may be favorable, or two favorable, one adverse. Not possible to have all adverse or all favorable in this case. Is that okay? Because I'm using the same input component, but proportion is changing. Proportion is changing means you are reducing A component and increasing B component. If you are reducing A component, then it's favorable. If you are increasing B component, it's an adverse. So always you will have one adverse and one favorable in case of two materials available in that composition. The last final question, final answer being, one being material yield variance. What does it mean? Material yield variance. Material yield variance is nothing but, I ask you a question, why did you change from this ratio to the other ratio? You may say that, sir, cost efficiency, sir. I want to introduce a cheaper version of material more for reducing the cost. So because of that reason only, sir, 900 rupees usually adverse, no, we made it favorable because of including cheaper material here. Okay, the next question is, because of changing the composition, will the output gets affected? Will the output gets affected? That's the next question. Okay, let's see. For 1000 units, what could be the output, sir? For 1000 units, what could be the output? 100. For 1100 actual input, what is the output? 100. If the same input with a standard proportion, if I give, output should be in what ratio? Standard output ratio. It means for 1000 input, you will be getting 100 output. For 1100 input, how much should be the output? Come on. Okay, standard. Actually, you are going to compare between standard and RSQ. Input 1000 means output being 100. 1100 input means how much should be the output? Cross multiplication gives us a clue, 110. 110. So, because of changing the mixture, you argued that, so I saved the money, sir, 180 rupees favorable. Okay, because of changing the mixture. Between these two, one item becomes very costlier. Immediately, I thought to reduce my cost, where I increase the cheaper product or input more proportion. Okay, you do happy. Because of the changing in the proportion, will the output gets affected or not? That's the next question. If the 1100 being the mixed under standard ratio proportion, your estimated output being 110, but you now get only 100 units. For the same 1100 units of actual input, if you are mixing and the standard mixture ratio, you may get 110, but you got only 100, so you are losing 10 units. You are losing 10 units. If the output is decreasing, then you are unsatisfied with that. You are unsatisfied. Now, come on. The formula in this case being actual yield minus standard yield. Okay. For actual input into standard price per unit of output will be taken. Yield means output, no. Until earlier 4, we have taken either product A or product B, or raw material A or raw material B. When it's all about yield, it's talking about output. In case of output price will be taken. Actual yield for 1100 units being 100. and standard yield for the actual input being 110. You lose 10 units unfavorable. What is the price per unit? Price per unit? Huh? Come on, get the total. 6,000, 4,800, 10,800 is the actual cost for 100 units. Am I right? So output price being 108. So standard price per unit of output being 108. I will now take this 108 here. Yes, come on, tell me the final value. 1080 adverse. Adverse. Is that okay? If you add up these two, you'll get this value. So for cross check, material cost variance is equal to material price variance plus material quantity variance. Material quantity variance is equal to material mix variance plus material yield variance. Material cost variance in this case being 2000 adverse from the workings, price variance being 1100 adverse, quantity variance 900 adverse. Yeah, matching. Quantity variance 900 adverse is due to mix variance, which is 180 favorable. Because of changing the mixture, you spend less money, no problem. Though you spend less money, but output is very lesser than the actual estimated. So, plus due to the lesser output, you lose the benefit 1080 rupees adverse. Adverse. So we are going to calculate these two additional variances here. One is material mix variance, another is material yield variance. Under material mix variance, the point you have to understand here is find out the standard mix for the actual input. Actual input for that actual input, as per the standard mixture, what could be the A and what could be the B's proportion. Now the next question, for the standard input of 1100 is the output. For the 1100 units of input, what could be the output? You have to calculate, and based on that you can find out the yield variance too. Clear? Come on, make a note of it. Now, let's move on to the next illustration, one of the comprehensive illustrations. Are you ready? Online students, come on, text me. I'll brief here. So, material cost variance, material price variance, material quantity variance, no problem. You are master with that in the previous illustration itself. Here I have introduced two more variances called material mix variance as well as material yield variances. Okay, the material quantity variance formula being standard quantity minus actual quantity into standard price will be taken. Similar to that, you will get the MMV where RSQ will be taken minus AQ into standard price will be taken. And RSQ is nothing but standard mix for actual input. Okay, you take the actual input as it is, as per the standard mix, what could be the proportion that is called RSQ, then use that RSQ for the calculation. In case of material yield variance, actual quantity minus standard quantity of what? Not the given standard quantity. You have to find out the standard quantity for the actual input. Okay, standard quantity for actual input as per the standard mix. As per the standard mix. With that, you have to multiply standard price. All these things are for raw material, but here output. Here output. Standard price of the output. So actual yield minus standard yield. Actual yield minus standard yield. Yeah, standard actual output minus standard output. Okay, here standard yield in this case is nothing but what? Standard yield for actual input, this one. Okay, this one. So quantity also be calculated for the actual input. Output is also calculated for this one. And third step, you have to calculate standard price per unit of output. Total standard cost divided by total output will be the standard price per unit of output. Okay, total output, standard output. Okay, or standard yield. Clear? If you add up these two, you will get this one. If you add up these two, you will get the material cost variance. This is very, very important. Clear? Now, I request you to try this illustration yourself. Come on, make a note of it. You try it yourself. A company is manufacturing a chemical product making use of 4 different types of raw materials. So, we have been given 4 raw materials. And there is an inevitable normal loss of 10% during the process. For April 2007, the management furnishes the following information. The output obtained being 92,000 kgs. Okay. A, B, C, D, and where we have the normal loss and output. Output being 92,000. Actually, if the input being 100, normal loss 10 will go, 90 will be the output. So 90 being 92,000 means what could be the input? In that input, A, B, C, D are being in this proportion, 40%, 30%, 20%, and 10%. Okay. Then you can proceed here. This will be the input, output being 92,000. 92,000. Okay. What about the loss here? Actual loss being, come on, tell me what is the total? 42, 31, 18, 9, 40, 80, 1 lakh. Am I right? 1 lakh. Actual loss 8,000, so that output being 92,000. In case of standard, A, B, C, D, total input being 40%, 30%, 20%, 10%, 100. This is what about the total input. In that, usually we lose 10 units for the process, the output should be 90. This is in terms of percentage. To compare the standard and actual, output should be same. It means what could be the standard cost for 92,000 units. For 90 output, 40 should be A and 30 units should be B and 20 units should be C and 10 units should be D. If it is being 92,000 units, how much should be A, B, C, D and all you have to calculate. That's what about the standard quantity. Standard price is there and standard cost also be available. Come on, try to solve this. Make it faster. I just prepare a working note here for solving this illustration. Okay. For the standard, we have been given these informations. So A, B, C, D in total input and loss, then you'll get output. Whatever the percentage given, I may post on the left hand side. So 40%, 30%, 20% and 10%. Overall 100 being the input. The estimated loss being 10 and 90 being the output. Standard quantity, standard price. And of course you can multiply the standard cost. You multiply this so that you'll get the standard cost also as a tabular format. Similarly, actual quantity, actual rate, actual price and actual cost. Here the cost for A, B, C, D being standard price being 50, 80, 90, 100. This is standard detail, actual detail. I am going to post the actual detail here. Okay. 42,000 units of A and 31,000 units of B, 18,000 units of C and 9,000 being D, overall 1 lakh and output being 92,000, 8,000 being the loss. Cost of material being 48, 80, 92, 110. So what you have to do? You have to get the standard details for 92,000 units. Understand? If the 90 being the output, 100 should be the input. If output being 92,000, how do I get this? Actual output should be compared with the standard output. If the standard output and the actual output are same, then only it can be comparable. 90 share is 92,000 means you can finish up calculating the rest using the cross multiplication. 92,000 into 10 by 90, 10 triple 2 and this will be 1 lakh, 2,222, 40% on this being 40,000, 889 and this will be 30,000, 667, 20% on this being 20,000, 444 and 10% being 10,000, 222. And it is better to get the RSQ. In case of RSQ, what the point you have to understand? Okay, RSQ is nothing but standard output for actual input as per the standard mix. Actual input as per standard mix. Actual input being 1 lakh. I'll take that 1 lakh here. For this 1 lakh, what about the standard mix? 40, 30, 20, 10. Okay, for the actual input as per the standard mix, what could be the standard output? So I'm going to get the standard mix 40, 30, 20, 10. 40,000, 30,000, 20,000 and 10,000. 10% will be the loss and output should be only 90. Clear? Now that's all. We got all the required information, so you can proceed solving all the 5 variances. So 2 predominant things are to be noted here. Number 1 being, here output should be equal, and here between these two input should be equal. Okay, for the actual input, as per the standard mix if I introduce, what could be the standard output? That will be the RSQ. That will be the RSQ. So it is better to complete this particular column also, so that you can simply copy and paste the calculations of others. Very easy. Okay. Without this one also you can proceed, but if you do so, that will be comfortable for you to calculate later on. 40,889 into 50, the value being 20 lakhs, 44,450. 80 into this value being 24 lakhs, 53,360. Here 18 lakhs, 39,960. Then 10 lakhs, 22,200. Okay, overall total being 73 lakhs, 59,970. Okay, calculate the same way for the actual cost. 20 lakhs, 16,000. 24 lakhs, 80,000. 16 lakhs, 56,000. 9 lakhs, 90,000. Total actual cost being 71 lakhs, 42,000. Okay, now we can calculate the variances. Material cost variance is equal to standard cost minus actual cost. Standard cost being 73 lakhs, 59,970. Actual cost, I can directly take the total of this two, so that I'll get the answer easily. Actual cost being 71 lakhs 42,000. The difference between these two, actually you are saving, then it's favorable. 2,17,970 favorable. You can show the value for A, B, C, D independently also, no problem. That time also you'll get the same answer. Then material price variance, standard price minus actual price into actual quantity. Actual quantity A, B, C, D. Standard price being 50, 80, 90 and 100. Actual price 48, 80, 92, 110. Actual quantity being this one 42,000, 31,000, 31,000, 18,000 and 9,000. 2 rupees cheaper, so 84,000 favorable. Per unit cheaper by 2 rupees means for 42,000 units 84,000 favorable. No difference. 2 rupees you pay excess adverts for 18,000, 36,000 adverts. You pay 10 rupees excess for 9,000 units, 90,000 adverts. Overall total being 42,000 adverts. Clear? Then we'll move on to the next one, material price variance, quantity variance. Standard quantity minus actual quantity into standard price will be taken. A, B, C, D. Standard quantity being this one. Okay. 40,889, 30,667, 20,444, 10,222. Actual quantity being this one, 42,000, 31,000, 18,000, 9,000. Standard price being this one, 50, 80, 90, 100, 80, 90, 100. Then the ultimate value in this case being 55,550 adverse. Next favorable, right? So you consume higher. Here also you get the adverse, 26,640 adverts. Next favorable. Okay, 2,19,960 favorable. Last one also favorable, 1,22,200 favorable. Ultimate value being okay, 2,59,970 favorable. If you add up these two, you'll get this value. Cross verify. 2,59,970 favorable, 42,000 adverts, ends with 2,70,970. Of course, first three are over. Then we have to go for material mix variance. Under material mix variance, SQ is replaced with RSQ minus AQ into standard price. Already explained what is called RSQ in detail earlier. So now I can solve just like that for A, B, C, D. RSQ being this one, 40, 30, 20 and 10, 40,000, 30,000, 20,000 and 10,000 and 10,000. AQ being this one, 42,000, 31,000, 18,000 and 9,000. Standard price being 50, 80, 90, 100. 50, 80, 90 and 100. 2,000 consumed excess into 50 means 1 lakh adverts, and 80,000 adverts, 2,000 lesser, so 1,80,000 favorable. Here 1,000 lesser favorable into 100, 1 lakh favorable. Ultimately you will get 1 lakh favorable. 1 lakh favorable. Now come on, get this value. For 92,000 total standard cost being 73,59,940 means what is the standard cost per unit of output? Divide the total cost divided by total output we earned. Under standard term 80 will be the answer. Now the last one being Material yield variance. Material yield variance. Actual yield minus standard yield for actual input with the standard output. Okay, with standard output into standard price per unit of output. Standard price per unit of output. Is that clear? Okay. Actual output being 92. If the input is introduced as per the standard mixer proportion, output is only 90. So actual yield is more than your standard yield expected. So you are favorable. You are in favorable situation. 92,000 minus 90,000 multiplied with the standard price per unit of output. Output price will be taken, which is 80 rupees. So 2000 units you produce more, so you are favorable. Multiplied with the 80 in terms of rupees being 1,60,000 favorable. If you add up these two, you'll get this one. So 30 rupees difference is there because of rounding of error. Okay, it's not a big deal. Clear? Hope now you'll be able to understand. Material quantity variance, price variance is equal to material cost variance. Material mix variance and yield variance should be equal to material quantity variance. Clear? Come on, make a note of it. If it is clear, text me. We will move on to the next one. Now, question number 5. This question also very easy. Only one difference is here. We have been given opening stock, purchases and all. Okay. Let me frame the table here. Calculate all material variances. Assume FIFO method of pricing material issues. Predominantly, you may expect FIFO method. The other methods are very rare, especially simple average method, weighted average method. You know, those things not expected in your examination. Very rarely FIFO method may come. Okay. And usually, all the 5 variances put together will be your comprehensive illustration. So, you put your attention to understand all the 5 variances. All the 5 variances. Let me start and explain this in detail here. Let's see. First, I'll frame the table here. For material A, we have 2 varieties of material, A and B. For material A, for material B, and total input loss, and you'll get the output. That's how the structure is made. Standard quantity, standard quantity, standard price, standard cost, actual quantity, actual price, actual cost. And don't forget to introduce one more column for RSQ. So the main point to be noted here is the output should be same for actual as well as standard. And between actual and RSQ, input should be same. Between these two, what should be same? Input should be equal. This is related to standard. These are related to actual. Standard and actual. Wake Limited produces an article by blending two basic materials. It operates a standard costing system, and the following standard have been set for raw materials. Okay. Standard mix being 40-60, standard loss being 15%. Whatever the information given related to the standard, first we'll finish up posting that in this diagram itself, so that will be comfortable thereafter. A introduced 40%, B introduced 60%, 100% should be the input. Actually, we expect 15 units may be lost and 85 will be the output. And price for A being 4 rupees and price for B being 3 rupees. Okay. So with that, I have posted this item. Let's now move on to the actual. The company produced 1700 kgs of finished output. The position of stock and purchases for the month given here. 1700 finished goods being 1700. They have been given the input and output details here. Clear? Let me try to solve this. Okay. What is the finished goods we produced? 1700. If the same 1700 supposed to be produced, what could be the standard quantity input? Output being 85, then input should be 100. Means if output being 1700, what could be the input? You can do the cross multiplication. After 15% loss, the output being 1700 means before loss, what could be the input? 2000 should be the input. Out of the 2000 input, 15%, 300 may be lost. 2000 being the standard input. In that standard input, A's ratio being 40%, 800. Am I right? 2000 into 40%. 2000 into 60%, 1200 for B. We got this. Then standard cost being 800 into 4, 3200, 1200 into 3, 3600. Overall cost in this case being 6800. We spend 6800 rupees for producing 1700 standard output. Then what about the price per unit? 6800 rupees is the total cost for producing 1700 units. It means 4 rupees is your standard cost per unit of output. For the actual, we have to calculate separately. Okay. A and B. Okay. So, opening stock. We have 35 units stock on the year beginning, stock on the year end, and newly purchased. 35 units in the beginning, opening stock, and add purchases. The number of units purchased being 800 units, and at the rate of rupees 3000, 835, and minus closing stock in this case being 5 units. So the consumption of material is 830. This is the real consumption, will be considered as an actual quantity for this illustration. Opening stock plus purchases minus closing stock is the actual consumption of material will be taken here. Okay. What about the rupees per unit? What about the rupees per unit? This is quantity, rupees per unit. This is total cost. 3000 for 800 units means per unit cost is rupees 2.5. Am I right? You can divide this 3000 by 800. 3.5 or 3400. Okay. 3400. Then what is the value? 3400 divided by 800? 4.25. Okay. Okay. And opening stock value is not usually given. In this case, standard price will be taken as opening stocks price. 35 into 4. How much is that? 140. Clear? This is for A. Similarly, I have to calculate for B also. In case of B, opening stock 40, quantity, rupees per unit and total cost. Opening stock 40, closing stock 50 and newly purchased item 1200 units with the total cost being 3000. 1200 plus 40, 1240 minus 50, 1190. 3000 rupees for 1200 units means per unit cost is 2.5. Opening information missing, opening price is missing, then you can take the standard price for the opening stock, which is 3 rupees. 120. Is that clear? Under FIFO method, first in, first out method, you consumed 830 units of A and 1190 units of B. Overall input being, come on, 1190 plus 830, 2020, but output is only 1700, so 320 being the actual loss. In this 830, how many units are for 4 rupees? How many units are for 4.25? As we follow which method? FIFO method. First 35 units will be considered at this rate. Out of 830, first 35 units are considered at this rate. 35 units at rupees 4. Balance will be the latest price, 4.25. How many units are from the newly purchased item? 795. Similarly, the next case, okay, 1190, no. Out of that, opening stock being 40 units, 1150 being newly purchased item. This 40 will be at rupees 3, 1150 units from the latest purchase price 2.5. Now you multiply 35 into 4, 140, 795 into 4.25, 3378.75. What is the total value then? 518.75. And 40 into 3, 120, 1150 into 2.5, 287.5. Okay, 2875. Okay, then total value being 2995. Overall value, this one and this one both put together, 6,513.75. Okay, so this is a comprehensive working you have to do. Comprehensive working you have to do. Clear? In RSQ, you have to take with what? You have to take with the actual input 2020 and mixer should be standard mixture. Out of 2020, okay, 2020, 40-60 is the ratio. Okay. So if you are not able to see the screen, log out and log in again, so you'll get the screen detail. Okay, no problem. Okay then. So as per the standard mixer, out of 2020, 40% being A, 40% percentage on 2020 being 808. This will be 12, 12, 12, 12. Hope if you are able to understand this one, the entire thing is already over. Out of 2020 being input, 15% may be lost. For 2020, 15% being 303 may be lost. So production should be 1717. Okay. Now, once you drafted this one, the rest will be very easy. Yes, come on. Calculate all the things one after one. First one being material cost variance. Standard cost minus actual cost. Standard cost being 6,800. Actual cost being 6513.75. The difference between these two, 286.25. You paid lesser, so favorable. Then material price variance, standard price minus actual price into actual quantity meant for the variances alone will be taken. Okay, we have been given two actual prices, 4 and 4.25 for A, 3 and 2.5 for B. And this is also 4, this is also 4, not a reason for the differences, only this part is the differences. Okay, 795 and 1150 can be taken here. So for A, standard price being 4 and actual price being 4.25. Number of units for which the payment is 4.25 rather than 4 being 795. Come on, 0.25 into 795. If you multiply, what's the value you're getting? 190? 8.75 adverse. Similarly for B, 3 rupees and 2 rupee 50 paise. Here it's a favorable situation. This impact will be on 1150 units. So 575 favorable. If you add up these two, ultimate value being 376.25 favorable. Okay, material quantity variance, standard quantity minus actual quantity into standard price will be taken for A and B. Standard quantity for A being 800, B 1200. Actual quantity being 830 and 1190. Standard price being 4 and 3. 30 units you consumed more for A, adverts into 4, 120 adverts. Here 10 units you consume lesser, so favorable into 3, 30 favorable. Ultimate value being 90 adverse. If I add up these two, I'll get this value. Cross verify this. Then next will be material mix variance, RSQ minus AQ into standard price for A and B. RSQ being 808 and 1212. 1212. AQ being 830 and 1190. In case of MMB, we don't get all adverts are all favorable. As we have two scenarios, two materials, one will be favorable, another one being adverse. Standard price for the first one 4 and next one being 3. 22 units you consumed more for A into 488 adverts. Similarly, in case of B, you consume 22 lesser, so 66 favorable. Ultimately, you spend 22 adverts because of the mixture. Finally, we'll go for the material yield variance. Material yield variance. Material yield variance. Standard yield minus actual yield minus standard yield for actual input with standard mixture multiplied with standard price per unit of output. Per unit of output. Actual yield is 1700. Standard yield for the same input being 1717. So you produce lesser, so unfavorable. Standard price per unit of output being 4. Then ultimate value being 68 adverse. If you add up these two, you'll get this value. 22 adverts and 68 adverts. In total, you'll get 90 adverts here. Clear? So we have to go for one more illustration. With that, I will complete material variances completely. One more class need to complete for the labor variances. 2 classes more than enough for the CMA group 1. And I think the second class I may organize by Sunday, because all the material variances and marginal costing you need to finish off in the practice session. Okay, especially material variances you try to finish up by Sunday. Another 2 or 3 hours are needed to complete the labor variances also. Then you finish up the sums from CMA group 1 book bag problems. Okay, once I complete the rest, then other illustration also you can solve. So I am giving 3 or 4 days gap only to revise all this content. Okay, go and watch the videos and sit to yourself and try to solve all the illustration. So only 5 aspects. First 3 aspects are very basic. Okay, cost, price, quantity variances. When we have 2 or 3 items, automatically we are introducing mix and yield variances. In mix and yield variances, a new concept comes here, RSQ, and standard yield for the actual input. Okay, standard yield for the actual input as per the standard mix. Then you are going to compare all these things with the check or equations to check, like MCV is equal to MPV plus MQV, and quantity variance is equal to mix variance and yield variance. That's how you can cross verify. The last illustration is pretty simple. In the absence of yield variance, how can we solve? In the absence of yield variance, the information regarding output may be missing. If the information regarding output is missing, what you can do? Very simple. You may introduce one more variance called material sub-usage variances. This is very simple. If you add up what MMV and MYV is equal to MQV. Similarly, if I add MMV and MSUV, you will get MQV. That's all. Then what could be this formula? Okay, what could be this formula? Otherwise, if you subtract MMV from MQV, you will get the metal sub-usage variance. If I subtract this one from here, AQ gets cancelled. Am I right? So naturally, what happens? The formula being SQ minus RSQ into standard price. That's all. This will be applicable only when we don't have the yield information. If you are not given the output information, given standard is matching with the given actual information. Both are same. Because if you want to compare the variances or find the variances, first step is to check whether the actual output and standard outputs are same. But if the output is itself missing, then what you can do? The given standard is always equivalent to the given actual information. So you don't need to do any more adjustments in the absence of output. In the absence of output, first you have to assume that the standard is for the actual one, same. Second one is you have to find out the material sub-usage variance. We don't have the material variance, right? So the formula is this one. Come on, try to solve this one for A, B. S cube being 800, 1200, RS cube being 808 and 1212. Standard price being 4 and 3. Here 8 you consumed more, so into 3, 4, 32 adverts. Here 12 you consumed more, so 12 into 3, 36 adverts. Overall value being 68 adverts. You will get the same answer, right? This one is prepared only in the absence of output details. If the output details is given, this will not be working. This you should not prepare this one. Okay, metal sub-usage variance should not be prepared. Clear? Come on, make a note of it. So we'll move on to the last illustration for material variances. In this illustration, from the following information, compute material variances. Okay, so we have been given standard information 10, 20, 20, 50 being the input, and cost is also being given, and actual also be given, the actual total cost also given. Output is missing. So if the output is missing, you can assume that the output for the standard being 1, output for the actual also being 1. That's all. You assume. Means both are matching. You don't need to worry about that. Yes, come on. Calculate material cost variance. What's the formula? Standard cost minus actual cost. Standard cost information is already given, which is 200. Actual cost information being 150. If I subtract 150, what's the value you are getting? 50 favorable. You get 50 rupees favorable. Material price variance. Standard price minus actual price into actual quantity will be taken for 3 types of materials, A, B, C. Standard price being 236, actual price being 365. Actual quantity being 5, 10, 15. Then 5 rupees you paid excess adverse. 3 into 30, 10, 30 rupees you paid excess adverse. 1 rupee you paid lesser into 15. 15 rupees favorable ends with 20 rupees adverse. Material price variance is over. Material quantity variance. In material quantity variance, what do you do? Standard quantity minus actual quantity into standard price. For A, B, C, standard quantity being this one, 10, 20, 20. Actual quantity being 5, 10, 15. Standard price being 236. 10 minus 5, 5 units you consume lesser into 2, 10 rupees favorable. 10 units you consume lesser into 3, 30 rupees favorable. 5 consumed lesser into 6, 30 favorable. Almost 70 favorable. If I add up these two, I'll get this value. It's now correct. You got the answer. Next one is all about material mix variance. I am segregating this into mix variance as well as yield variance. But we don't have the yield variance, then you can use sub-usage variance. In MMV, RSQ minus AQ into standard price for A, B, C. What is RSQ? What is RSQ? Actual input but standard mixer. Okay. Actual input being 30. Standard mixer means out of 50, 10, 20, 20 is a standard mixture. Otherwise, 1:2:2 is a standard mixture. Then this actual input 30 will be now shared in the ratio of 1:2:2. Then 6, 12, 12. This is called RSQ. This is called RSQ. Now come on. Calculate here. RSQ being 6, 12, 12. AQ being 5, 10, 15. And your standard price being 2, 3, 6. So 1 rupee your one quantity you consume lesser means 2 favorable, 2 lesser 6 favorable, and 3 higher 18 adverse. So ultimate value being 10 adverse. 10 adverse. Similarly, next one being material yield variance. We don't have the material yield variance, then material sub-usage variance could be equated with that in the absence of material yield variance. Here the formula being material sub-usage variance is equal to SQ minus RSQ. How can you remember easily this formula? Very simple. If you add up these two, you will get this value. Otherwise, from here you have to subtract this one. So where AQ gets cancelled. Right. So for A, B, C, SQ being 10, 20, 20, RSQ being 6, 12, 12, standard price being 2, 3, 6, then 4 you consumed lesser, 4 into 2, 8 favorable, 8 consumed lesser, 8 into 3, 24 favorable, here 8 consumed lesser, 8 into 6, 48 favorable. What is the ultimate value? 80 favorable. If you add up this 80 favorable, 10 adverse, you will end with 70 favorable. With that, all the variants of material variances over. In the next class, we will finish up labor variances and we combine both material and labor variance as a single illustrations in the next class. Okay, finish up copying and go on do practicing this and